insane story of how an executive working with a software company decided to make a payment of not just the interest amount to the lenders of the client, but the entire principal amount as well, resulting into a legal case in the United States. Hello, everybody. Welcome to the YouTube channel. I'm your learning partner, Sushila Hariharan. And if you're interested in a career in global markets, hedge funds, and investment banking operations, do subscribe to my YouTube channel where we provide content-centric videos on these topics. It was the prime of the lockdown year 2020 when everybody was working from home, and some organizations decided to allow their executives to come to office. But most of the time, it was September of 2020. It was a peak of the lockdown year. People were not allowed to move out, etc. And we had some operations being, work from office, but most of the executives were working from home. In this scenario, this is the background. So let us understand the business scenario. The business scenario is Citibank was a lead banker of a syndicate of lenders to a company called Revlon. Most of us who use makeup and skincare products are familiar with the term Revlon because we know of it as being one of the leading cosmetic majors in the United States. So what does a syndicate of lenders mean? A syndicate of lenders means that the lender have formed a consortium with other lenders, that is other banks, and collectively with a single legal document, they have given a loan to Revlon. Okay, so the syndicate of lenders has given a single loan. Each bank has participated in different proportions, and they have collectively given a loan to Revlon. And because of this background syndicate, every syndicate has to have a lead banker, and in this case Citibank was the lead banker. All information from this video has been sourced from publicly available data, newspaper articles, and there has been no insider information that has been provided because of the utmost secrecy which has been kept on the issue of banking operations. Coming back to the case, so the business scenarios, there is a syndicate of lenders, and collectively the lenders have given a loan to the company, the borrower, called as Revlon. Most of the activities of the lender and as were carried out by the lead banker. This includes collateral management, documentation for collateral creation, the legal requirements of creating a hypothecation on the plant and machinery, and any other securities that were provided by the borrower for getting the loan from the lenders. So all this was taken care of by Citibank. What Citibank's executive did, the payment for the interest was coming nearer. So most of the payments and transactions of Citibank worldwide were being handled by multiple entities in their different offshore operations across Asia, South America, Eastern Europe, etc. So what happened was, when one of the interest payments was to be made, okay, so to the other bank, to the lenders, Citibank as the lead banker was making the payments on behalf of Revlon to all the other lead bankers, to all the other bankers as well. What happened was, an executive working at a processing unit making and processing this payment, perhaps working out of home, instead of just paying only the interest amount, made the payment of the entire principal amount as well. The lenders were bewildered. This was a multi-million-dollar loan, and instead of receiving interest running into like 10 or 15 million dollars, they suddenly received $300 million or $400 million as the principal repayment. Now this is just not done because the loan was not due for payment. Neither had Revlon authorized the repayment because they clearly didn't have the money at that point of time to repay the loans. But because of the mistake and the error committed by one of the executives, the entire principal and interest amount was made out to the lenders. This is called as operational risk. We are familiar with many cases of credit risk and market risk, but there are very few cases that come out about operational risk. Operational risk is the risk of not following the procedures, procedural lapses, system failures, software glitches, natural calamities like earthquakes, to tsunamis, etc. So in this case, it was very, very ironic that even if a payment is to be made, it has to go through multiple levels of checking by senior executives before it hits the bank accounts of the counterparty. How did this payment get there? How does this payment go through so many eyes? In many organizations, this is called as the 4 eye principle or the 6 eye principle, the maker checker principle. That is, the maker is the one who is making the transaction, the checker is the one who is verifying the transaction, authenticating the transaction, checking the transaction, and only then can the payment be made. But over here, in a very weird and bizarre situation, the maker checker principles collapsed, the 4 eye principle collapsed because this executive made the payment and none of the systems caught the error. Look, a payment of a few $100,000 is a big amount of money, but imagine the amount being $1 million payment, and banks have to provide for liquidity for that. They just can't make a payment of $1 million or hundreds of millions of dollars on a single day unless they provide for the treasury and the liquidity departments to actually make sure that that money is in their bank to facilitate to other banks. They cannot do that. Clients cannot do that. Only if the client authorizes payments can they make the payment to the other lenders in the syndicate. So how did this transaction take place? What were the system glitches? What was the operational failure? Will remain an inner uh, circle of stories because it will never come out in the public. But this case went legal, okay? Because when the banker went and told the other bankers in the syndicate saying that, look, I'm sorry, we made a mistake, despite that, the other bankers refused to return the money and they closed off the level on the verge of closing of the loan, saying that this is actually a pre-closure of the loan. Revlon's financial condition was also a little wobbly and therefore they were not very comfortable with continuing with the exposure for city, against Revlon, and this really resulted into what is considered to be one of the most open cases of operational risk that has resulted into a court case. Okay, and it resulted in the court case in the US legal system because it really brought out the aspect of how operational risk affects banks. Okay, what is the loss for Citibank for this? There is a tremendous amount of loss. The first loss is you have parted away with, let's say, $800 million instead of just parting away with $8 million. Okay, this results into severe liquidity crisis or liquidity crunch for the bank because they didn't have that kind of money for this transaction. They might have had that kind of money for multiple transactions, but they didn't have this kind of money for that single transaction. And it of course raises the doubts about how strong are your 4 eyes or 6 eyes principle, because this is a very important aspect of global competencies. That is, your global competency centers depend upon multiple rounds of verification of data because you're literally dealing only with data, and unless that is verified, that is authenticated, how can it go through multiple levels of seniority? How could it have escaped the strong IT systems of the company? How could it penetrate those levels of thresholds that would have been imposed by the by the bank software on on authorization levels of different executives? All this is a big question mark, but the case has been resolved. It has now been resolved. The lenders decided also to take the bank to court, and the lenders return the money back to Revlon, because this is not return the money back to Revlon, return the money back to Citibank, because this is all done in good faith. All banks work in good faith because they know very well that they don't intend to cheat or fraud another bank. Okay, and they recognize that it was an operational error. It must have cost the bank a lot of money in liquidity management, because they would have had to borrow capital for the short to medium term from other counterparties at very high interest rates, and it of course resulted into a loss of reputation, because the obvious question and the obvious point being that how could it have penetrated several thresholds of authorization that would have been imposed, right? And this is the case of operational risk that I wanted to discuss with you today, because such stories are never heard generally in the public domain. Thank you so much for listening in.